So we've talked about the history of money, we've talked about the Forex market, the quotation system, we've talked about terminology, pips, lots, all of that stuff. Now it's time to look at brokers so you can see which broker you want to open an account with so we can start playing around with things. So what exactly is a broker? We've talked about that. A broker is going to be the entity that facilitates the execution of your order, right? And what is an order? An order is just your instruction to buy or sell something. So whenever you're going to be buying or selling something, you're going to be sending an order, and there's different order types, which we're going to be looking at later when we look at the platforms. Yeah, that's what your broker's job is to do, is to receive your order and execute it for you. Now, how do you choose a broker? Because there's hundreds and there's too many brokers out there, okay? Well, first of all, what do you want in a broker? Number one thing is you want your broker to be regulated. What that means is you want a broker that has oversight, and the more the regulation is, the better, right? Some brokers are not regulated at all, and they can do some pretty shady stuff, and they can go bust at any time, okay? So you don't want that. Again, you also want transparency. So you want a broker that tells you what's going on. You want alignment of interest. Some brokers are notorious for, bad practices where they give you huge amounts of leverage because they just want you to blow your account as fast as possible for them to make the fees because they're trading against you, right? They're taking opposite positions. So you want to make sure that your interests are somewhat aligned. Some others, situations, brokers do take the other side of your trade, but they hedge themselves, so they're not really doing that. It's something that's important as well. Low fees, obviously extremely important. Good leverage, obviously important. Now, you don't want 1,000 to 1 leverage. You don't want the max out there, but you want something that's okay leverage for you to do your trading. You want a good platform, also very important. So most brokers actually offer, MetaTrader 4 and, the common platform there, which is the one we're going to be using. But you need that. And then support. Support is very important because if you're having any issue, if you can get good support, that's really helpful. Now, all of that being said, what I'm going to be doing in the next lecture, I'm going to be showing you in the next few lectures, showing you which broker I would recommend, but I'm also going to be giving you a shareable Google Sheet where you can recommend brokers. I can take a look at them to see if they're good or not, and I can add them to the list. I'll talk about that later, because not all brokers are going to work for all countries. Some do not accept different countries, and because of that, this sheet is going to be helpful to you so you can see what other people are using and which one could be best, but I'm talking about that later. So these are the things that you want to look for in a broker. So when we're talking about brokers, you're going to see that there's two types of brokers. There's A-book brokers and there's B-book brokers. So what is an A-book and a B-book? An A-book is the order book that has the major liquidity providers. Okay, so you see all the buyers and sellers from other liquidity providers like the big banks and all of these other providers that you can buy and sell FX from. Okay, when a broker is using this book, so the A book, he is sending your order to be executed with one of those liquidity providers. So it's like the stock market in type of a way. There's orders from other people, there's an order book, and your broker just reroutes your order to buy or sell from one of these other, venues. This is the order book used by ECN brokers, which, this is more recent. We've seen ECN brokers more recent than before. It's a more recent occurrence that we see ECN brokers. And usually what they're going to do is there's going to be this order book, they're going to reroute your order, and they're going to charge a commission because of doing that. Exactly in the same way that stock brokers do. Now, the most common one that you're going to find is going to be B-book brokers, which these ones, their order book is an in-house order book. The buys and sells, they're not getting them from other liquidity provider. They actually generate these orders. So this order book. So when a broker is using this order book, he is taking the other side of your trade, right? Meaning if you're buying, he's selling it to you. He's taking the opposite side. He's betting the opposite direction of what you're betting. Now, for him to make money, he has a spread, right? the difference between the bid and ask, which we talked about. And this is how he makes his money, because you might buy, so he sells to you, but somebody else is simultaneously selling, so he buys from them at a lower price. And he is making the spread, the difference between the bid and ask. This is the order book used by market makers. So this is why we call it market makers, because these brokers are just making a market for this currency. They're buying it from people who want to sell it, and they're selling it right away to people who want to buy it. And they keep buying at the bid and selling at the ask and making money from the spread. Now, some of these brokers will hedge their positions, meaning if everybody is selling USD and then they have too much USD, well, they might go ahead and sell it to one of those liquidity providers, right? To eliminate the risk that actually USD loses in value and then they lose money. So they have risk management techniques, but in the end, they are taking the other side of the trade, which I kind of don't like too much, because that means that your interests are not aligned. They would want the other, they would want the position to go against what the majority of their client wanted to go. But if they're hedging their positions, that's eliminated. So, a lot of them also hedge their positions. It's just a way for them to control their risk. So if you have the option of two different types of brokers, a book broker that just charges you a commission would be best. But then if you have a B book broker that hedges their position, is not bad too. But then a B book broker that has a bad reputation, that has wide spreads to make the most amount of money on you, gives you huge leverage, you don't want to go with something like that. Okay, so we've said that you have brokers that use an A book and brokers that use a B book. Now, if you have the option between two brokers and they're as good as each other in terms of reputation, trustworthiness, all of that stuff, you would prefer to take a broker that uses a book. Why? Because there's no true conflict of interest. There might be, but a little bit less. So if you're looking at a broker like IC Markets, okay, this would be a true ECN broker. And you see here, they say they're an ECN broker, so you know that they're using a book. And because of that, you see that the spread that they have is often zero. And this is a very high leverage, you shouldn't need as much, but they offer that to you. But their spreads is very small. Now, why is their spread small? Because they're not artificially creating a large spread to make commission. They just don't charge you a spread. They route your orders to, a lot of liquidity providers. So you send your orders, and where there is these orders, there's other orders from banks, HFTs, dark pools, and you can execute against them. And they charge you a small commission. So that's how they make their money, right? Now, I'm going to talk about this broker and the broker I recommend in another lecture, in the next lecture, but this would be an ECN broker. Now, you can have something else, like let's say Rwanda, which is not a ECN broker, okay? So they actually have a wider spread. And you see, if I look at USD CAD, so if I want to sell this, I can sell it at 1.33479, but if I want to buy it, I'll have to buy it at 1.33496. So if I buy and I sell right away, I'll be losing a bit of money. And how much would I be losing? 0.00017. So that's 1.7 pips. And you remember that if we're trading one lot, one pip would be $10. So 1.7 pips would be $17 on a one lot contract. Okay. Well, which you're not going to be starting to trade by one lot. You're going to be starting to trade at the minimum quantity, which is 0.01. But you can see that the commission plays a fact. Now, the only difference, you are going to be paying commissions regardless of where you're trading. Okay. The only difference is with a broker like this one that doesn't use a book, the spreads will vary based on the volatility. Because when he's buying from you or selling to you, most often what they're going to do is they're going to hedge their position. They're going to go into other liquidity providers and get that position at a better cost to them, and the difference between what they sold it at to you and what they were able to buy it at is going to be their commission, their profits. The other ECN brokers, they just don't do that process, and they send your orders right away to those liquidity providers. You get the fill, and they just charge you the commission for doing that thing for you. So in the end, it kind of it's almost the same thing in terms of how much you're going to end up paying. But with these, some brokers, if they're not reputable, they will highly inflate the spread. And what they would want is they would want you to lose, because they actually are taking the opposite side, and they're not always hedging that position. They're not going out and buying it. So that's where there's conflict of interest. So when I'm saying if you have an option, take an ECN broker, not only if it has a really good reputation, because even with ECN brokers, there's a lot of bad practices that they can do. They can send your orders to HFTs that don't actually get you the best price. And by the time you get filled, you get a worse price than you would have gotten with one of these other brokers that has a better reputation. So I would say, being with a broker that's very highly regulated and has a very good reputation is very important. And then if those things are equivalent, then if you have one that's true ECN, that would be slightly better than one like that, but only if, regulation and trustworthiness are on the same page. Now, in the next lecture, I'll say which broker I recommend that you should start using. Okay, so which broker do I recommend that you use? So I'm going to give you two options here. In the next lecture, I'm going to add a shareable Google Sheet where you can see other resources as well, or other options. So the first one I'm going to recommend is IC Markets. IC Markets is actually one that I've used before. It's based in Australia. It's very, very highly regulated. And they have a lot of amazing things. So high leverage, you shouldn't use all of that. It's a true ECN broker, which we like. Order execution, ultra fast. So 40 milliseconds is basically the time from the moment you send your order to the moment it gets executed. It's 40 milliseconds. To put that into perspective, there's 1,000 milliseconds in a second. For your eyes to see an information on your screen, it takes 200 milliseconds. So this is pretty quick. It's not HFT level, but it's pretty quick. Institutional grade liquidity, so they have huge order books that they can access, so you can get filled very quickly. What else? They have other things you can trade, indices, bonds, stocks, commodities, so you can trade other things through them as well. What else here? Okay, powerful trading terminals. You can work on any platform, but that's all of these brokers are going to have that. MetaTrader 4, which is the most popular platform, and then they're all going to have MetaTrader 5 as well, but they're all going to have their own trading platform. Now, what's really nice about this one is they have a lot of options for you to fund your account, okay? And they have pretty fast and quick withdrawals. Now, I used to use this one before, but they started rejecting, or from I guess about a year and a half ago, maybe, I can't remember exactly, they stopped accepting Canadian residents. So since I live in Canada, I'm not allowed to use them, or maybe it was a bit less than that. It was a bit less, maybe less than a year ago. They stopped accepting Canadian residents. So I had to pull out my money and stop using them, as well as every other Canadian. And I think it was a regulation thing, where our regulators, there was something with the regulation. But just to say, it's not all brokers are going to accept people from all countries, okay? So, for example, IC Market, I can't use anymore, but you might be able to use it. So what you have to do is just Google it. Can I use IC Markets for, wherever you're living, Japan? Can I use IC Markets? Does IC Market accept residents of Japan? And you'll see. If you can get with them, open an account. If you can't, no stress. There's a bunch of other brokers. So now the one that I'm using is Oanda. So Oanda, and I'll open it on another page here. Very, very reputable broker. Okay. They offer a little bit less leverage, so it's 50 to 1. Okay. But again, when you're starting off, you don't want high leverage either, because your objective is not high risk. It's to be low risk in the beginning, because that's when you're learning. So we want as least risk as possible. So it's perfect. They're not a book broker, they're a B-book broker, but they offer tight spreads. So their spreads are tight, the execution is good. I've had good, experience with them. They have a fix and REST API. Those are APIs if you're automating something, if you're doing something automated, which I'll be making courses on that at one point. I also have access to CFDs, so trading other products, you can do that. You can transfer funds through your bank account or through PayPal. And the thing I like the most about them is their customer support. Okay, if there's anything, you get a dedicated person that's responsible for your account. As soon as you open your account, they talk to you, they email you, they call you, they set everything up. If there's any problem, you give them a call, you have their number, so you're always talking with the same person, and they get everything set up for you. And that's regardless of the amount of money you're starting with. Even when you're starting with a small amount of money, they're very good. So this one works if you're living in Canada, and then probably with these two, regardless of where you're living, you would be able to open an account with one of them. In the next lecture, I'll have some more resources in case one of these doesn't work for you, or in case you just want something completely different. So with most of my courses, what I do is I create a shareable Google Sheet. Now the purpose of this sheet is to have resources for the product that you're trading. So for our case, this sheet is for Forex resources. It's gonna have a section for brokers, calendars, news providers, charting, and other resources. Now, I've done something similar for stocks. In the beginning, when I start the sheet, there's nothing on it because this is something that students collaborate together to fill it out. So the way this works is if you find the broker or you know of a broker that's not on the list here, you can just, when you open the sheet, it's going to look like this. You can right click and add a comment and tell me, hey Mo, what do you think of the broker, whatever, FXCM, or you can tell me, I use FXCM and they are great, I think you should add them, okay? And then comment, and I'm gonna get your comment. So this sheet, you can add comments to it. You cannot edit what's already here. You can just comment things in. Now, you're gonna see that here for Oanda, I've also added that it works for Canada because I live in Canada, I use it. Now, if you live in Japan and you're able to open with Oanda, just put me a comment here. Say, hey, I use Oanda in Japan, please add Japan. Right? And likewise for IC markets. If you're living in a country and you figure out that it works there, add it. And this way, what happens is on my Google Sheet, my version here that I have, I get your comments. And I can see that, somebody said, hey, I use Oanda in Japan, please add it. I can comment, sure, thank you. I'll reply. I'll resolve this, it'll go away, and I'll add here Japan. If you're talking to me about FXCM and I check it out and I find that FXCM is a good broker, I'll add FXCM over here and I'll add it and I'll add all the information so other students can gain from that. And the reason why I do this is because I have students that are from 150 different countries. So I don't usually know which broker which works for which country, which calendars are good for which country. So even here, I might add a section for countries, right? Or whatever. So which other resources works for which country, I wouldn't be able to know for all the countries. So that's why I need your help in filling out some of the resources. So if you find that you use something that's not there that you would like other students to know about, add it in. And as time progresses, this sheet is going to be really filled up. And if I show you the one, let's say that I have for stocks, well, this is the Google Sheet for stocks that I have for my other course. When I started this sheet, there was nothing on it. And if you look now, it's filled up, right? And this is just for US and then Canada. And for this sheet, I have so many countries. And when we started it, there was nothing on it. So this is a very good tool, and the other reason I like it is because you can have this sheet, you can save it, you can send it to your friends, and every time I update something on it, it'll update for everybody, right? So as time passes, in a year, in 2 years, if there's something new I added there, you have access to it. So keep it handy, it'll be filled up, and send me any recommendations you have that you think are going to be useful for other students as well. Okay, so what I want you to do now is go ahead and decide on which broker you want to use and open an account with one of them. Now, when you go to open your account, you're going to have the option to open a live account or just a practice account. Now, I recommend you start with a practice account, so it's a simulation account. You could also open a live account, but just to use the simulator if you want. Now, I recommend you do this right now because it sometimes takes a while for them to approve your account. So a few days to up to a week maybe to get your account approved. You're going to have to send some documentations and stuff like that based on which country you live in, proof of residence, all of that stuff. And then your account will be open. Now, the difference between a live account and a simulation account is the only difference is in the simulation account, you're not actually trading with real money. So it's virtual money, it's simulated money. So it's just pretend money, right? So you're buying and selling and you're making profits, but it's all fake money. It's important that you start with a simulation account because you're going to be making a bunch of mistakes in the beginning. You're learning, right? It's like if you're learning to play soccer, you're not going to go on the field on your first day. You're going to be practicing and playing with other people and getting better, and then when you're ready, you're going to go on the field. So you have to start with a practice account, okay? So make sure you start with a practice account, and later on, once we go over trading and all of that stuff, only when you're making profits, and we're going to have a sheet to record your historical trades, only when you see that you're profitable and you're confident, then you go to a live account. And even when you go to a live account, you're going to start off small to make sure you're able to reproduce the same results that you did in the simulation account in the live account, because when you go live, then psychology kicks in, emotions kick in, a bunch of things, even trade executions are sometimes a bit different. So even when you go live with a small amount of money, you make sure you're generating good results, good profits, and only then do you start scaling up and put bigger amounts in. And this is the professional way of doing it, right? Even me, you see here, I have this account here. This is my Mo test account 4. This is one of my 4th. I have practice account, tests accounts, different brokers. Because whenever I test something new, a new strategy and something new that I'm doing, I test it out first. Even though I've been doing this for like 10 years now. So, if you're starting off, then for sure you should start off with a practice account. Make sure you do that. So I've got you to look at different brokers and to choose a broker for yourself to open an account with. Now, before jumping into the different platforms and sending orders and whatnot, I want us to look at the different ways of analysis, because this is going to be the foundation that you're going to be using to try and forecast which direction a specific currency is going to go. Now, you have 2 ways of analyzing a currency. One is technical analysis, and the second one is called fundamental analysis. Now, what is the difference? First of all, what is technical analysis? Technical analysis is going to be the discipline that uses price and volume to identify trading opportunities. So whenever you're looking at a chart like this, which we're going to be getting into that in the next lecture, you're going to be using technical analysis because you're looking at prices and volume in order to predict which direction it's going to go. So you can use anything that has to do with the prices, indicators, a bunch of other things that we're going to be looking at, and volume to try and predict which direction this is going to go. That's the only thing you're going to be looking at. So you use technical analysis basically to have a systematic way of finding high probability entries and exits to generate profits out of this market. Now, what is fundamental analysis? Everything else. So basically everything else that doesn't have to do with price and volume is part of fundamental analysis. So you can look at the politics, you can look at interest rates, employment, GDP, trade deficits, printing money, anything that's not price and volume could be fundamental analysis. So you're looking at fundamental criteria that have an impact on the supply and demand for a specific currency. The way I like to compare technical analysis and fundamental analysis is by looking at real estate. If you're looking to buy a property, well, are you going to look at fundamentals or technicals? Well, it depends. It depends how long you're expecting to hold that product for, that house for. If you want to buy a house and you want to hold it for, 20, 30 years, well, you're going to look at fundamentals. Why? Because you're holding it for long term. So you want to make sure that it has a solid foundation. You want to make sure that it's isolated, so during winter heat doesn't just dissipate. You might want to make sure that there's not going to be a bridge built near your house in the near future. You want to make sure it's in a great neighborhood. All of that stuff, right? You don't care too much about, current price, how much the house next door just sold, or things like that, because you're holding it for 30 years. So you expect its value to be based on these fundamental things that you looked at. Now, you might also want to look at how much you can rent it for, all of that stuff. Now, if you plan on just flipping a house, buying it and selling it, then you're not going to look too much about fundamentals. You don't care if in 10 years there's going to be a bridge. You don't care about all of these little things. You don't care about the isolation. You want to buy it and sell it the next week. What you truly care about is technicals. So, what is the supply and demand right now? So how many houses transacted, how many purchases and liquidations happened in the last month and the last week? How much houses nearby in the same neighborhood sold at, and how frequent that is. That way you can have an idea of how much you can sell it at very soon, so you can buy and flip the house. It's the same thing in all types of trading. When you're looking at something for long term, you have to keep in mind about the fundamentals, because that's what's truly going to matter in the long run. But if you're trading something in the short term, then there's not enough time for those fundamentals to be valued correctly. What you want to look at is technicals. Now, that doesn't mean that if you're trading short term, you should just disregard fundamentals. It just means that you're going to look at it in a different way. So, what I suggest that you do, and this is how I and most traders have learned, is to basically start off with technicals. And the reason why is because technicals are way easier in the Forex market. Okay? So you start off by technicals, looking at different technical indicators to give you a entry and exit points. Now, while you're doing that, you also have to look at fundamentals to avoid big events that might impact the currency very strongly. Now, as you're doing that, fundamentals is going to be something that you're going to learn as you go. Why? Because fundamentals is so broad, and it's not a set function that you can just follow. There's so many things that can happen and that interact with one another. To really understand fundamentals for Forex, you need to do several macroeconomic classes. So it's a long period of study to really understand how these things impact one another. And the best way to do that is, as you're trading, read the news, see how different events impact your currency, and you're going to learn more and more and more about fundamental analysis and be able to use that to have longer term directional plays on different currencies and know exactly when a specific event happens, how that will affect your currency, so when it happens again in the future, you're able to capitalize on it. I myself still today learn a lot about fundamental analysis as I see more and more types of events. And some types of events I've seen so many times that I trade on them in a very confident way. So in this course, technical analysis is going to take the larger portion of this section, but we're also going to look at fundamental analysis in a way to look at what should we avoid so we do not get hit while there's a specific type of event. And then as you go along, as you go through your career of trading, you're going to learn more and more about fundamental analysis. So it's finally time to start looking at charts, which is what technical analysis is, right? Some people call technical analysis the study of charts, which is what it is. Now, that being said, what type of charting software are we going to use? The one I'm going to recommend right now is going to be TradingView. TradingView is the most popular charting software in the world right now. Now, that being said, depending on which trading platform you're going to decide to use, so example, if you decide to use MetaTrader 4 to enter and exit your positions, you can do your charting right away in that platform. And I am going to show you also how to do your charting through MetaTrader 4. But you might decide to use another trading platform. You might decide to use MetaTrader 5 or CTrader or whichever platform that your broker offers you as well. Well, for that reason, I want to show you also how to use TradingView, since TradingView anybody can use. And also everything that you're going to be able to do through the charting here, you can do in any other charting software. Another reason why I like TradingView is because you can do the charting for everything else within TradingView. So I do my charting for stocks, for cryptocurrencies, and for Forex through TradingView, which you can't do through MetaTrader 4 because MetaTrader 4 is just for currencies. MetaTrader 5 has more options. But that being said, when you're learning, it's very good to learn on TradingView. You can also do the charting on your platform as well, and you can see which one you like best. And in this course, I'm going to be showing you TradingView, and I'll also go over MetaTrader 4 later on in the course once we get into the trading platform. That being said, TradingView has a lot of different things that you're going to like as well. When you go on their main page, there's a lot of things that you can see here. You can follow people, there's top authors that you can follow, you can look at their analysis, you can comment, you can read other people's comment. So it's a very good place for you to learn. There's calendars in here, there's a bunch of things. There's screeners, Forex screeners, crypto screeners, there's a bunch of things, and then you have your charting. So if I go on my charts here, okay, you're gonna see one thing. Top left, you're going to be able to put the currency that you want to look at. Example, if I want to look at USD CAD. When I put USD CAD, you're going to see it gives me, well, first of all, I can select what am I looking at. I'm looking at Forex. Well, in Forex, I have 4 different things here. Why? Because they're coming from different brokers. So here I'll be getting the prices from FXEM, here from Oanda, here from Forex.com. So I want to get prices from Oanda. So I click on Oanda, I have it here. Right? Let me just change it. If I go back, USD CAD, I want the prices on Oanda here. So I have my charting that's coming directly from the broker Oanda. Now, if your broker isn't there, it's okay. You can select another broker. The prices will vary between brokers by maybe 1.5 pip, not more than that. So it doesn't really matter too much, but if your broker is listed on there, select that broker. And you can look at your chart here. Now, the really nice thing here with TradingView is I can create different lists. So example, I have lists for cryptos, for stocks, for US, for Canada, and I have one for FX. I can go in, let me go in pairs. Here I have some cryptocurrencies, I go FX, I have all of these. And I can just look at charts by clicking on them very quickly. And you can add different currencies here. So if I remove USD CAD, if it wasn't there, you can have your list here and add different currencies. I can put USD CAD and add it here. Then it becomes very easy to have multiple currencies. You can also click here on layout and have different layouts. Example, if you want to look at 4 currencies simultaneously, I can click on this, select which currency I want to have where, and then look at multiple currencies simultaneously, right? Which is super nice. Now, there's a bunch of other things that you can do, which I don't want to jump into right away because I want us to look at the basic charting, but then we'll look at some other things that you can do that might be very helpful to you. So that being said, if you don't have an account with TradingView already, make sure you go right now and open an account with them. There are several subscription packages. The first one is free, so you can just use that one if you want. I have the pro version because I'm using a bunch of the other bells and whistles, but start off with the free version only if you start wanting to use something and TradingView actually tells you, hey, sorry, this is only available for pro or premium users, then start considering upgrading, but start with the free version right now and play around with it a bit as we look into the next lectures. this lecture, we're going to look at candles, candlestick charts, and line charts. Now, whenever I pull up a chart, or whenever you see charts online, you see these things here that are composed of some green things and some red things. Well, what are these things? This is what we call candles. And all of these candles compose a candlestick chart. So it's a chart of candles. Now, what is each of these candles? Well, a candle is basically a representation of the prices in a given period. So let's say I want to look at one day, the period of one day, today. Well, I'm going to look at the candle. And the candle is going to give me the first trade of the day. So the first execution of the day that happened, the price of that. So if the day we started at $10, let's say, it would have a $10 opening price. Now, throughout this one period, this one day, prices will fluctuate. Maybe this currency is going to go up, so it's going to be 10 for, it's going to go up to 12 for one, and then it's going to go down to 9 for one, and then go back to 10 for one, and then go up again. What this candle is going to show me, it's going to show me the opening, then it's going to show me the low that it had throughout this day, the high, and then the close. And this is going to be a candle. Now, if the price closed at the end of the day higher than it was in the beginning of the day, it's going to be a green candle, because it's going to tell me that prices went up for that period, in this case for a day, right? Now, if the price had closed down, we would have had a red candle, because in a red candle, the close you see here is lower than the open. And then there's a high and there's a low. Now, the low and high are represented by wicks. These we call wicks or shadows. And those are basically candles. So if you have red candles, you know that prices went down for this period. If it's a green candle, it went up. So when I look at something like this, well, I can say, for example, that this is a daily chart that I'm looking at. So here you can see that I'm looking at daily. That means that each candle represents one day. I can look at this candle, this is today. Well, this candle would be yesterday. You see here it says at the bottom the date. So this one was May 1st. The one before was April 19th. The one before, April 30th. The one before was April 29th. The one before, April 26th, because there was the weekend, right? So if I look at yesterday's candle, I can see it's a green candle. So prices went up. So in the beginning of the day, the price was 1 point. Well, you can actually tell from here. There's the open, high, low, close. So when I go over a candle, I can see these numbers changing. I can know that here it opened at 1.33904. That was the opening price. Okay, and sometimes it's hard with the mouse to get it exactly if I'm looking at here, but if I pass it on it, you see it here. Okay, so 1.33904. The high was 1.34615, and then it closed at 1.34378. So at a higher price than it opened at. Now this is because I'm looking at a daily chart. Okay, and I can look at other days and be like, well, let me just zoom out here. Here there was a lot of consecutive red days. Okay, here as well. Okay, and I can see that some days, you know, something might have happened this week because we had a lot of consecutive red days. What happened? You can look at things like that and try and analyze. Now, you might not always want to look at daily charts because maybe you want to intraday trade. You want to trade shorter period. You don't want to buy something here and hold it for 3 months. Maybe you want to buy something and sell it tomorrow, or maybe in an hour. So you can select different chart length types. So for example, maybe I want to look at 1 hour charts. And then what happens is that each candle is going to represent an hour. Now look at this. If I'm looking at this chart now, each one of these candles is an hour. So I can see that this is today, May 1st at 6 p.m. This candle was an hour earlier, so at 5 p.m. This one was an hour earlier, so at 4 p.m. You can see that here at the bottom. Here we go, 4 p.m. And so it starts at 4 p.m. and it finished at 5 p.m. This candle was at 3 p.m. This candle was a bigger candle and it was at 2 p.m. So each candle is now a 1 hour candle. And then you can do your analysis because you're trading within an hour range. You can look at 15 minutes candles. And in this situation, again, each candle is going to represent 15 minutes. So this one is at 6 p.m., but this one started at 5:45. This one at 5:30. This one at 5:15. So you can do different types of trading. You can do short-term trading or long-term trading. And based on if you want to do short-term or long-term, you're going to look at different time frames. So for me, I always look at the daily charts to get a global idea of the direction that we're going. But then if I'm doing day trading, so buying and selling within the same day, I like to look at 5 and 15-minute charts. If I'm looking to do a little bit longer than that, I would look at 1-hour charts. If I'm looking to do some swing trades where I'm holding for several days up to a few weeks, I'll look also at 4-hour charts. Now, that being said, those are the charts that we're going to be studying. Now, these are candlestick charts. And let me get back here to daily charts. Now, are you going to use this type of charts or other types of charts? Well, if I click here, you can see that there's a bunch of different types of charts, right? There's the candlestick chart, and then there's the line chart. Now, if I click on the line chart, you'll see that it doesn't have all this information, because a line chart is basically a chart that has the close on each period. So it only connects these dots, okay? It doesn't have the high, the low, and the open as well, so you can get a more clearer picture of what happened on that day as well. So it's way simpler. Now, will you use this? Not really. You'll use the candlesticks, because the candlesticks give you the most information possible. Now, the only times we're going to use line charts is when we're comparing different currencies together, and then you might want to just look at the lines to be able to compare them. But other than that, we'll always, so 95% of the time, going to be using candlestick charts. Now, some people like to look at these other chart types. I haven't had any type of better prediction value using them, and I have always used this one. And most of the traders that have traded for me or that I have encountered in other trading shops only really use the candlestick types. There's a bunch of different informations out there, a bunch of different things, but a lot of these things don't add value to you trading and will just end up confusing you and giving you more information that is not needed, to be honest. So for me, stick with candlestick charts. It's more than sufficient for everything you're going to be needing to do. In this lecture, we're going to be looking at trends and trend lines. So what are trends? Trends is basically a trend. You've heard of that before, right? There's a trend. Everybody going in a specific direction, right? So it's the same thing in currencies. A trend is when a currency is going in a specific direction. Now, you can have a uptrend, which means the trend is going up. You can have a downtrend, which means it's going down, or a side trend, which means it's going sideways. Now, an uptrend is characterized by higher highs. So you see here there's a high, the next higher is higher than that, and higher lows. So this low, you see that the next low is higher and the next low is higher. So when prices are going like this, that's an uptrend, because each high is higher than the previous one and each low is higher than the previous one. Downtrend is you have lower lows and lower highs. So you have a currency that's going down, and you see that each time there's a low, it's lower than the previous low, and the highs are lower than the previous highs. And side trend is basically where it's, equivalent. The highs are equal to each other and the lows are somewhat equal to each other. So we're trading in a range like this. So you might have realized or saw earlier that on my USD CAD, I had some lines here. Well, you see here, you can see that there's, some type of trend since September 2018, right? Now we're in May 2019, and there's this type of trend here. You can see that every time we have a high, and let's see if I can draw on here, or even a low, let's just look at the lows. Every time I have a low, okay, there's a low here, but look at the next low. The next low is a bit higher, and look at the next low. The next low is a bit higher as well, and look at the next low, also a bit higher. So it doesn't have to be perfect, but you can see that each low is higher than the previous one, right? And I can see also that the highs are higher, right? Each high is a bit higher than the previous one. So what does that tell me? That tells me we're in an uptrend. So the currency is going in a specific direction. USD is strengthening versus CAD. So it's taking more and more CAD to get you $1 worth of USD, right? And you might have heard the expression before, the trend is your friend, or don't go against the trend. Why? Because it's been proven that when something is going in a specific direction, it's more likely to keep going in that direction, right? When you have momentum, when you have a force in a specific direction, let's say a train going in a direction, it's hard for it to stop or go in the other direction. You need an opposing force that has, a force equal or bigger than that force to make it slow down or change its direction. And it's the same thing with prices. So when you see that there's a trend in a specific direction, you want to make sure that you're not going against the trend unless the trend breaks. Now, to be able to have a better idea on this, what we usually do is we draw a trend line. So a trend line is basically just a line that we draw on either all the lows or all the highs. I'll explain the highs later, but let's say on all the lows for now. And this trend line makes us really see the direction of the trend and when the trend breaks. So in this case, if I have a trend line here, you can see that whatever this product is, it's going to be supported. Why? Because everybody's looking at this trend line. So every time the price hits the trend line, people know that it's going to bounce off of it. And usually prices will bounce off a trend line. But when it breaks, it'll break and it'll go in the other direction. So if we go back to our example here, I can actually look at this chart and see, well, okay, can I connect these lows here? And I can take this line tool, trend line tool, and just see if I can connect them, right? And it doesn't have to be perfect, it's just an approximation, okay? And some people don't just draw one line. Some people like drawing two lines, so they'll take one line here and they'll do like a range. They'll take another line and they'll be like, well, because usually it's a range, right? It's not a perfect science. They'll be like, this is the support level, and they'll have like two lines. But for simplicity's purpose, let's just draw one trend line, okay, and leave it at that. You can tell yourself that, okay, well, because of this trend line, I see that the direction is upward. So the next time that this currency drops here and comes here, I'm gonna buy it. Why? Because everybody else sees this direction and everybody else sees this trend line. So everybody else expects this currency to bounce off of this trend line. What does that mean? That means when the price comes here, they're all going to be buying, putting pressure on this currency and pushing it back up. So some people always wonder, well, do trend lines work because they work and it makes sense? Or is it because everybody thinks that they work, and because of that, they all place orders on these key locations, and because of that, it works? So is it really something that works, or is it a self-fulfilling prophecy? Everybody says it works, so everybody applies it, and because everybody applies it, it works. And we don't know. I think it's a combination of both. Obviously, the impact of everybody following trends and using them has an impact on it, but also there's something to it as well that makes sense. So we'll be drawing trend lines to be able to look at the direction and see if it's a good place to buy or sell. In this situation, if the currency comes here, I know it would be a good entry spot for a high probability trade. And if the price breaks it, I would not want to go long this currency because there's more likelihood that it breaks down. So this is what a trend line is. In the next lecture, we're going to explain support, resistance, and channels. In this lecture, we're going to look at channels, supports, and resistance. So what a channel is basically two lines like this. So even from the example we saw in the previous lecture, you might have noticed that things, when they move in an uptrend or a downtrend or a side trend, they don't just have a line at the bottom. They have one at the top too, because it moves within that range. So I could have drawn this one here, by adding another line. I could have just taken another line and connected the highs as well. And by doing that, I would have seen that the price here for this currency trades within this channel, right? And in this situation, I know that when the price comes here, there's a high likelihood of it going back down. So if I'm buying here, when the price comes here, I should sell because there's too big of a likelihood that it comes back down. And if I'm holding it, then I would have wasted all this time holding it for nothing. I could have bought here, sold here, bought here, sold here, bought here, sold here. Instead of just, imagine somebody else who just buys here and holds it. And he holds all this time. Well, he would have been from here to here, he would have been flat, not making any money. But somebody else who says, okay, well, I'm not going to buy here, I'm going to wait, and he buys here, sells here, buys here, sells here, makes way more money, and is only using the capital for a fraction of the time. So it's very important to look at this type of stuff, not only for where you're getting in, but for where you're getting out. And things usually trade within that channel. And that's not just in Forex, that's across products, in cryptocurrencies, in stocks, in anything, things are trading within a channel. Now, what do we call this bottom line and what do we call this line at the top? The bottom line is what we call support. So when people are saying, hey, it's hitting the support, it's above the support, we're talking about the bottom line. Why do we call it support? Because it's supporting the price. The price is trying to go below it, but it can't because it is being supported by this line. So we call it the support line, okay? And this is when it breaks, people say, the support just broke because the price broke below the support. Now, the line above is what we call the resistance because for the price to go over it, there is resistance, it's causing resistance for the price. So the price isn't able to go over it and bounces off and goes back down, bounces off, goes back down. So this line we call the resistance. So resistance line is the one above, support line is one below, and the price is going to move between them. Now, that doesn't mean that the resistance is never going to break or the support is never going to break. They are going to break. It just means there's less likelihood of them breaking. Now, where do we find supports and resistances? Well, we find them around the trends. When there's a trend, you're going to have a support and you're going to have a resistance. But not only in those situations, we often find support and resistances around round numbers. So this is not necessarily the only place where you're going to find support and resistances. You might find a resistance at a round number. So let's say at $1.50. Here, there's going to be a resistance. Why? Because at round numbers, psychologically, it has an impact on people. So a lot of people might be like, well, you know what? At $1.50, I'm selling because it's too high. So there's going to be a lot of orders, a lot of people transacting at those round psychological prices. And same thing with prices lower. So you might say at a round number of 120 or $1 or 110. There's going to be a lot of buy orders because at those prices, a lot of demand is going to cause the currency to be supported. So supports and resistances are not only with trends, but they're just something that have to do with people placing buy or sell orders and affecting the supply and demand at particular price levels. Okay, and this happens often at round numbers. Now, the more round the number is, the bigger the impact is. At $1, that's a very big round number. $2, very big round number. Well, 150 is also round. Well, 110, 121, those are also round. 115, 120, 125 is also round. But some of them are less round than others. So again, we'll go from $1, $2, that's very round. 150, that's round. 125, that's round. But then, 110, 120, 130, those are also a bit round, less than the others. Then 115, 145, 135, they're also round but a bit less than the others. So the impact is going to be less on those than others. But every single round number that you have, there's going to be a bit more supply demand. So bigger potential for support and resistance than at regular prices because people don't think often of, I'm selling at 142.22.2. No, they'll be like 150, you know? So you'll have a lot of support and resistance at those levels. And again, the rounder the level is, the more of a support or resistance is possible to be there. Now, another thing that we want to look at is one of the properties for supports and resistances. And this property is role reversal. So when a specific resistance or support breaks, it actually reverses and becomes the inverse. Example, if we had, let's say, this support here that we have, and the price, oops, let me take this off, and the price all of a sudden breaks down, okay? Let me see if I can draw it here. I'll take the brush, and the price breaks down, okay? Well, what happens if the price comes back up? You know what's gonna happen? This support line is now gonna become a resistance, and the price is gonna bounce off of it and go down. And it might bounce off of it several times. So supports and resistances tend to reverse their roles once broken. And same thing with round numbers. If, for example, the price of this currency decides to just went up and then broke, let's say it bounced off 150 a few times because it's a round number and there's a lot of resistance, but then broke over it. Well, you know what? It might now become the new support. And prices might now bounce off of the 150 in this way. Now, why is that? It might be because of a psychological effect. So people at one point were saying, oh, 150 is too high, it's too expensive, it's not going to break there, and they're just selling. But then once that breaks and it goes higher, well, when it comes back to 150, people are like, oh, it's back there, I can finally buy, it's not as expensive as before, and they start buying at that price. And this also have been proven often. So round numbers, or not only round numbers, but any support and resistance, when they break, there's a very big likelihood of them changing and becoming, the inverse. So let me, even if I check real quick right here, let's see, I'm looking at this support here, but let's say I'm looking at this one. Look at here. Sorry, my camera just shut off, so I had to replace the battery real quick. So to continue where I left off, if I'm looking at this chart here and I'm trying to find some supports and resistances, real quick here I can see that, there's a resistance here. But look at this. When this resistance, okay, when we broke over it, look at this, it became the new support and prices started bouncing off of it, right? Now I'm just looking at this real quick, but often what you're gonna find is things are gonna trade in ranges, and when they break the range and they go on another range, the resistance becomes the new support, right? And if it breaks the support is going to become the new resistance. So that being said, go on TradingView and create a list of currencies of the major pairs and go over them and see if you can spot some supports and resistances and draw trend lines on them. So you can see if you can find some channels that will give you a general direction for that currency. This will give you some practice into looking at charts, and of course, don't worry if you don't spot them right away. This skill gets better with time as you look at more and more charts. In this lecture, we're going to be looking at volume. So volume is the other thing that you look at that's part of technical analysis. You have the charting, so the prices, because all of these come from prices, but you also have the volume. And the volume is this thing you see at the bottom. And the volume is basically the quantity of funds transacted, right? So the more money is transacted, the higher the volume is. Now, why would you care about volume? What would volume tell you? Well, does it make a difference if there's $1 billion that were transacted or $100 billion? Yes, it would, right? If you're looking at real estate and all of a sudden you see that prices of houses in your neighborhood increased because one guy bought a house at a very high price, does that give you an indication that prices will continue to increase? No, it's just one guy. But let's say all of a sudden there's hundreds and hundreds of people who start buying and selling at higher prices in your neighborhood, Well, would that give you an indication that prices are increasing? Yes. And sometimes you'll even see the volume, the quantity of transactions increase before the price increases. So you'll see that a lot of people are buying and selling, and then you'll slowly see prices going in one direction as there is more demand than supply, or supply than demand, right? So the quantity of transaction has an impact and is very necessary when prices move in a direction in a strong fashion. Otherwise, they might just revert, and it might just be because of a low amount of supply or demand. That's why something went up. Let's say there's 5 people who want to buy houses in your neighborhood, but nobody's selling. Then prices might go up, but it wasn't pushed up by demand. It was just a lack of supply at that time. So I would prefer seeing hundreds of transactions and the price is going up to tell myself, hey, it's demand that's pushing up prices and not a lack of supply. So in the same way, when you're looking at volume, you know that for directional moves, if there's a lot of volume, you have more confidence in them. And if you want a change in directions, it's also necessary that it comes with big volume. So if I look here, let's say I'm looking at Australian dollar here. Okay. Well, I can see here. Okay. So I can see here there's a spike of volume here. So volume was pretty low. And then at one point, prices really dropped. And you can see here that volumes really spiked. And then when volume spiked a lot here, we stopped. And then volume really kept on spiking and prices went back up, and then we recovered. And even here, you see that there's a bunch of volume. So volume was pretty okay. And then at one point, volume really spiked. And you can see that volume spiked actually here. You can see here there's a volume spike. Okay. And this is here. Right? So prices hadn't even dropped. And then prices dropped with an increase in volume. So everybody was agreeing with that. There was a lot of selling, and that's what pushed prices down. And you can see then we had a change in directions. We had a change in directions, and prices started to go this way, right? And you can see that if you are looking at volume, that might give you warning that something might happen. And you see that volume's coming in, and you'll be like, okay, well, let me just step away and see what happens. And then when, we broke down here with high volume, then you might say, okay, well, look, we're breaking down and there's high volume. I think that this is going to keep going in that direction, because it's not just a few people or a bit of money that's saying that. It's a lot of money that's saying we're going in that direction. And then you might take a trade in that direction. So volume helps pretty much. So always have an eye out on volume, regardless if you're trading 1 day charts or if you're trading 1 hour charts or 30 minutes. When you're looking at volume, it might tell you when something is going on, right? It might tell you something is about to happen or something is happening, and you might want to take off your orders, not trade for that period, or wait until something happens and enter a trade in the same direction as the volume. So it's very helpful. So make sure you always have it on your chart. So in this section, we're going to be looking at chart patterns. Chart patterns are a subsection of technical analysis. And basically, chart patterns are patterns that you see on charts that have historically shown that if these patterns show up, there is more likelihood that the price of this financial product would move in a particular fashion. So either this pattern, once it breaks or once it forms, there's more likelihood that prices will move in a certain type of way. So chart patterns are used because they are believed to have predictive value on future price movements. And traders are going to be using these chart patterns to choose an entry and exit points while they are trading. So they really help you systematize your way of trading. If you want to buy something, well, you could look at chart patterns and figure out where exactly to get in, where exactly to get out, and reproduce that type of trading through looking at similar patterns and reproducing those trades. This being said, why do chart patterns work, and do they work? Now, there's a bunch of chart patterns out there. You can see lists of, dozens and dozens, I want to say hundreds of patterns, some not widely known. So are you going to learn all these patterns? What patterns are good? What patterns are not good? The thing is this, a lot of these patterns, if everybody believes a pattern is going to work, it might be a self-fulfilling prophecy, right? So if I tell you, if you see, a rabbit, then the price is going to go up. Well, what if everybody looks at that and everybody believes it? And obviously you can't have a rabbit on a chart, but let's say if I say, if you see a triangle, well, prices are going to go up. Well, what's going to happen? If a triangle forms at one point, for a reason or not, then if all the traders know about that and everybody believes it, then all the sellers now believing that the price will go up are going to cancel their orders. And all the buyers who believe that it's going to go up might buy at more aggressive prices. And thus the price will go up because we believe that this pattern would cause the price to go up. So it's a self-fulfilling prophecy. Now, it's not because some people know about these chart patterns that they will work. Some other patterns make sense. So some patterns, they actually make supply and demand sense. So when you think about them, it makes sense that if you see that chart pattern, prices will behave in that particular way. So the patterns that I like to look at are patterns who have reason behind them. Because all patterns have this, self-fulfilling prophecy type of mentality behind them, where you could say, well, everybody sees them, so that's why I'm going to use them because everybody knows them. But then you're not putting all the odds in your favor. If you want all the odds in your favor, just choose the patterns that have more meaning to them. Not just because everybody knows them, but because there is more meaning to them. Everybody knows them as well, but there's meaning to them as well. So the patterns that I'm gonna show are the ones that I think are the most valuable. Some of them I'm not gonna show. And if you have a recommendation for one that you think is valuable, put it down in the Q&A section and I might add it if I believe it's of value. But for the time being, I'm really gonna put the ones that I think are the most beneficial, so you don't just have a list of a bunch of patterns that aren't gonna add value to your trading. So the first pattern we want to look at is the double top, double bottom, or multiple tops, multiple bottoms. So it's, I guess, 4 different types of patterns here. Now, these patterns work across financial industries. So you can be trading currencies, you can be trading cryptocurrencies, you can be trading stocks, futures, whatever you want. These patterns make sense in any type of product. Okay. Now, let's say the double bottom. The double bottom is basically when you have a financial product and it touches a low point, goes back up, and touches this low point again. We call this double bottom. So it hit this bottom twice. What that tells me is that if we get back to this level, there's going to be a lot of support because everybody sees that this is a key support level. There's a lot of demand at that level. And if prices go down there, what's going to happen is the prices are going to bounce off of that level and go back up. So if you are a trader and you're looking to get into a long position and you want to go long this product, well, a good place to put your buy order would be just above this support level. So if the prices fall, you are likely to just get filled and then prices going up where you start making money because there's a lot of support here and there's a lot of other buyers at that level. And this is what we call a double bottom. Now, you can have a triple bottom, which is when the prices tests that level more than 2 times. So that would be a triple bottom. And this is why we call it multiple. There's multiple because it can test it 4, 5, 6, 7 times. And the more times it tests that level and bounces off of it, the more robust this level will be because more people will see it. It will have a stronger impact and it'll be a stronger level. So that being said, this is what, a double bottom or a multiple bottom would be. If I have another chart here, if you look at this here, we have a multiple bottom. So it touches a level here, comes back to it, goes back up, comes back to it. So again, if you would have just seen this double bottom, then you might have been able to buy here and make profit on this move. But now when there's a triple bottom or multiple bottom, And now if the prices go down again, you can rest assured that there's going to be a lot of support at this level, and you might want to put a buy order just above it in the case that you want to buy this product, right? So this can be used to give you an indication of where there's going to be a lot of demand. Now, if you want to look at the tops, it's just the inverse, right? So if prices are going up and they touch a level here, goes back down, touch the level again, well, here we have a double top because it touched this level 2 times. So you would be thinking that if it gets back to this level, we're going to bounce off of it and go down. And this is what happened here. And now we have a multiple top because it touched it more than 2 times. So we have several times that it touched this level. So there's a resistance at that level, a lot of sellers, because a lot of people think that this is too high of a price. Now, when you're looking at the Forex market, you can try and understand, well, and actually let's open a Forex chart right here and it'll make more sense. Let's say I'm looking here at, let's see here. Well, we could say here that there's a double bottom here, and if it goes back down to this level, we might want to buy. We could say here, well, let's see. Well, here we had a triple bottom here. So let's draw a line here. So initially, if you're trading this currency, you would be like, okay, well, you know what? I have a double bottom. We hit it here. We hit it here. Then if we're coming back to this level, you might want to put a buy order here if you're looking to buy this currency. So why? Because you know that there's a lot of support at this level, and here it bounced off of it. And look at this. Now, even if you missed these, there's a triple bottom here, so multiple bottom. If you extend this line, you'd see that it bounced off of it again, and just put this. It bounced off of it again. So you could have, if you wanted to be long this position, you wouldn't buy it just here or buy it here. You would wait to buy just above a certain support level, and you would have been able to buy here and make profit on this move. You might have probably, if I was trading this, I see that there's a bit of resistance here as well. I might have been able to buy somewhere like here, let's say, would be able to buy somewhere here because I know that this is a support level, and then as soon as it touches the higher resistance level, I would have sold and made this amount of profit, right? Now, you can fall into the practice of thinking, well, why is there a support here? Why is it bouncing off this level? Why is it not bouncing off of that level? And try and understand it. Because you could argue, or you can try and say, okay, well, for these currencies, if the currency falls above, let's say if I put USD CAD, if the currency goes to $1.50, you know what? Then the Canadian dollar is very cheap versus the US dollar, and then there's a lot of exports that are happening from Canada to the US because now the Canadian dollar is very cheap, and because of that there's a lot of currencies exchanged to be able to buy these products, and that causes the demand to fluctuate from here and there. But this is fundamental analysis, this is not technical. And if you're a true technical analyst, what you're saying is prices will reflect this fundamental information, so you don't need to do it. It's already in the price. If prices are bouncing off these levels, you don't need to understand what exactly is the reason. Is the reason because companies are selling at this level? Is it because traders are selling at this level? Is it the government that doesn't want the currency to go over that level and trying to manipulate the currency? You're just seeing that this is what is, and you are going to profit from that because you are seeing it through the chart. Now, we will look at fundamental analysis in a way, but just to let you know that when you are a true technical analyst, and which I don't suggest that you just do technical analysis, you should do everything, but the mindset is that this other information is reflected in the price. So when you are looking at prices, it's not necessarily that important to see, well, what exactly caused it at that price to revert, just that it is more likely that it reverts when it touches that price. And this is what bottoms and tops and resistance levels can help you do. It can help you figure out an entry point, an exit point, so you can get in, get out, and move on to the next trade. So this does it for multiple tops, multiple bottoms, double tops, double bottoms, and I'll see you guys in the next lecture. this lecture, we're going to be looking at ascending and descending triangles. So first off, ascending triangle, what is it? So it's basically when you have prices going up and they're being wedged in a way. So you have prices going up here and they're hitting a level, which is a resistance level that's stable, okay? But then every time they're going back down, they are supported by buyers. And then it's going back up, but then sellers are selling at the same level, okay? So they are as confident in this level. Now, as prices are going down, buyers are being more aggressive, so they're buying at higher prices. So the lows here are getting a bit higher. And then prices goes up and sellers are consistent about their price, pushing it lower from here, and then they keep pushing it here. But buyers keep pushing their buy orders higher. So then the price is getting wedged in a way, okay? The thing is, you can see that sellers are very robust on a level. There's a lot of sellers on this resistance level. Buyers are being more and more aggressive. So what usually happens, and it's not always the case, is in a ascending triangle, so a triangle that's going up, buyers will win at one point and the sellers are gonna be completely executed. They're gonna sell whatever they want to sell, and buyers are gonna push the price higher, and then the price will explode in this direction. Now, you never know if it actually will or will not. Sometimes sellers actually win, buyers are exhausted, there's not enough of them, and prices go down. So when you see an ascending triangle, the right way to play it is wait until there is a break. And if the price breaks above, then you can get in here, expecting the price to go higher. Now, if it doesn't and it breaks below, then you can get in on a short position, expecting the price to go lower. Even though there is more likelihood that it breaks up, it's a smaller likelihood, right? You always want to wait until the break to get into a position whenever you're looking at any type of triangles. So this is the ascending triangle. The descending triangle, we'll actually draw it here, is just the inverse, okay? So you would have a chart and you would have the price of your currency here. That's basically going down in a way, and it's hitting a level, and then it's going back up, and it's hitting back the same level, going back up, hitting back the same level, going back up, and you can see here that there is a triangle here, and this is, I guess, straight, and the triangle is dropping here, right? So the price is getting wedged here, and at one point it's gonna break. Now it could break either way, but it's more likelihood in a descending triangle that it breaks down. And this here, which is the support level, which was supporting the price at multiple times, once it breaks, it becomes the new resistance, and prices might tumble down. Okay. Now you never know if this is gonna happen, so you always wait until this happens so you can enter your position after it breaks, right? Because you don't know, it could have broken up, right? The price might have broken this way. Let's get the same color. Might have broken this way, right? So you never know. And this is why you want to wait until the break before getting into a position. But this would be the descending, right? Descending triangle. The other one was the ascending triangle. These ones you want to look out for because they happen often, and they can help you in getting, an entry and an exit, and then moving on to your next trade. That being said, I'll see you guys in the next lecture. In this lecture, we're going to be looking at symmetrical triangles. Now, the only difference between symmetrical triangles and ascending and descending triangles, it's that basically both supply and demand are being more aggressive. So instead of having, a resistance level that's flat, like in the ascending triangle, where, sellers are selling at the same price, or a support level that's flat, like in the descending triangle, where the buyers are buying at the same level, so there's a support. In this situation, both buyers and sellers are being more and more aggressive in their prices. So as you see here, you can have something that's going up and then sellers are, coming in, pushing prices lower, then buyers are coming in, pushing it higher, sellers coming in, pushing it lower, buyers coming in, pushing it higher, and the price really gets wedged in between. And at one point, one of them is going to win, either buyers or sellers. And you know, the further the price goes within the triangle, I'm trying to explain it here, the more the explosion could be bigger, right? So let's put it up here. Imagine this. Imagine I have prices here. I have a triangle. And then I have prices that are fluctuating. Let me actually draw the triangle here. A little bit easier. Okay. Let's actually take this off. Let's say I have this triangle. Okay. Imagine this. Imagine I have prices. Buyers pushing it up. Sellers pushing it, buyers pushing it. Now, if I break here, okay, you know, prices might tumble because I have this triangle, I kind of see it. But imagine this, imagine the price actually goes all the way within the triangle. So it gets wedged more, right? Buyers push it, sellers push it, buyers push it, sellers push it. And, you know, we get really deep within the triangle. Once somebody wins, either the buyers or the sellers win, so the explosion is going to be way bigger than if we broke somewhere around here or around here. So the further we go within a triangle, the bigger the explosion could be. So this is what we would call a symmetrical triangle. It's basically a triangle where both supply and demand are being more and more aggressive. You can't truly know which way it's going to break, so you always wait until the break happens as a confirmation, and then you can enter your position in that same direction. That being said, this is symmetrical triangles, and I'll see you guys in the next lecture. In this lecture, we're going to be talking about wedges. So again, wedges are another type of triangles. And you know what? For me, I see all of them in the same way, right? I don't remember, oh, this one is a wedge, this one is a symmetrical, this one is a... because it's all the same thing. It tells me something about supply and demand. And this is why I really like these chart patterns that have to do with triangles. So a wedge is basically another type of triangle where it's not very symmetrical in one direction, it's not symmetrical in the other, and it's not symmetrical in both. It's just a triangle. Okay, so you can see again where you're going to be having supply or buyers buying at more and more aggressive prices, sellers at more and more aggressive prices. Now it's not going to be symmetrical at all, so maybe buyers are going to be way more aggressive in their buying and sellers slower, less aggressive in their selling, but not you know, in the same way as a ascending triangle. So they could even be selling at slightly higher prices. It's just that both, if you look at the resistance level and the support level, they are going to meet at one place, and that's what we call a wedge, because the price is going to be wedged between them at one point, right? And the same thing with the triangles. The more the price gets wedged further within the wedge, the bigger the explosion could be. And the same thing that we've learned about resistance and support. When a resistance breaks, it becomes the new support, and when a support breaks, it becomes the new resistance. Okay, so these are wedges. You'll see different type of wedges again here in this situation. Buyers were way more aggressive and sellers, you know, fluctuated a bit. So you are going to often see these type of patterns, and these are the patterns that I like the most. The reason why I really like these triangle patterns, and I show a lot of them, is because they are one of the best patterns out there. They make sense, right? So there's a sense why they work, not just because it's a self-fulfilling prophecy and everybody knows them and everybody sees them, but it is a battle between buyers and sellers, and you can see that through the chart. So there is an underlying sense behind them. Second is because they're very easy to see. So when you're doing something, because it's a self-fulfilling prophecy, you want to make sure that everybody else sees it, right? So everybody sees these triangles. And this is the reason why I really love these patterns, and I show them here in this course. Some other patterns that you might have heard of, like head and shoulders, don't really make sense. Because yes, a lot of people know about them, but even though you might say, well, because they know about them, it'll work just because it's a self-fulfilling prophecy, they're very hard to find, to see, and if nobody really sees them, or not everybody sees them, then that self-fulfilling prophecy isn't really going to hold. And second, something like head and shoulders, well, it doesn't really make sense, right? So even if there was the self-fulfilling prophecy part of it, the sense, the logical part behind it isn't strong. So I don't want to look at patterns like that don't make too much sense and that I haven't seen work really well. I want to look at patterns like this that are easy to see and that have logic and sense behind them. And this is why right now we just looked at wedges. Keep an eye out for them, see if you can find some on the charts that you're trading. And this is going to be it for wedges, and I'll see you guys in the next lecture. In this section, we're going to be looking at technical indicators. So technical indicators are the biggest part of technical analysis. And the definition for technical indicators, taken from Wikipedia here, is technical indicators are a fundamental part of technical analysis and are typically plotted as a chart pattern to try to predict the market trend. Indicators generally overlay on price charts, price chart data to indicate where the price is going or whether the price is in an overbought condition or an oversold condition. So what this means is, so if I pull up a chart here of, I'm looking at Euro USD. If I want to look at a technical indicator is going to be something that's going to be plotted, overlaid on this chart. And this technical indicator, which there's different indicators, the way it's computed is going to be based on the prices that you see here and or the volume. Nothing else. It doesn't take any news, anything else. The only thing it uses to compute itself is this chart that you see here in front of you. Okay? Now different indicators are going to use different things to compute themselves and different ranges. So if I'm looking here at Euro USD, I can go on the top here and click on indicators. When I click on indicators, I'm going to see that there's all of these indicators that I can use. So there's average true range, there's oscillator, there's Bollinger Bands, there's RSI, there's moving average, there's VWAPs, there's all of these indicators, okay? And each of them is going to be computed in a different way, but all using the prices here and or the volume. So now we're going to look at different indicators. I'm going to look at the ones that I like the most for the Forex markets. Now, there's a lot of them. And it's not because there's a lot of them that you need to know all of them. A lot of them are useless and they're worthless, honestly. You can create your own indicator. A bunch of these indicators are just indicators that somebody just created, right? So you don't want to use too many of them, okay? And the one thing to remember is that all these indicators, they only serve to highlight something that's already visible. Since these indicators are calculated based on the prices, then you don't really need to put them on. You can just look at the prices and that will tell you what the indicator would tell you. The only reason why we actually use them is it makes it easier for us. It highlights this thing that we might be looking for that without having the indicator on and just looking at the chart we might not see. So it just serves as a highlight. Now, you don't want to use too many indicators. You want to find a few that you like and that work well for your type of trading and use those. And the reason for that is when you use too many things, you lose predictive value. You know, if you do any type of mathematics, you know that when you have a formula and there's several unknowns, like let's say y equals ax plus bz plus whatever variables, right? And you have many unknowns. If you try to add too many unknowns, you're going to lose predictive value. And they found in mathematics that if you use over more variables, more than 5 variables, you start predicting less efficiently than if you had less variables. For example, if I'm telling you, how can you predict if it's raining outside based on, you know, what your girlfriend, boyfriend is wearing? Well, you can type kind of predict, right? Because if she's wearing something like a raincoat, then it's probably raining. If she's wearing a skirt, then it's probably sunny. So okay, that's good. Well, how could you predict the weather outside based on what she's eating? Well, I'm not too sure. How could you predict the weather outside based on her mood? Okay. How could you predict the weather outside based on the TV shows she's watching? How could you predict? If you start adding too many variables to try to predict this thing, you're not going to predict as well if you just took a few variables that have more value and just use these. And it's, I don't know if my example was good to get to what I want to say or the meaning, but don't a mistake that, you know, new traders do is they try to use as many indicators as possible. And I look at their chart and they have so many indicators. They're just gonna go in and they're gonna just add everything. They're gonna add everything and they're gonna look at everything. And they're gonna be like, oh, well, this says this and this says this. If I have 20 indicators and 15 of my 20 indicators tell me that, then it should go up. Not necessarily, no, because some of them are gonna be conflicting. You're not looking at the same thing. So it's a mistake that all new traders do, okay? And I'm here to tell you, don't do that. Take a few indicators and we're gonna look at a few and you're gonna see me use them and stick with those, and you're gonna have way better result than just throwing all the indicators out there. So without any further ado, let's jump into the first indicator, and I'll see you guys in the next lecture. The first indicator we're gonna look at is the simple moving average. What the simple moving average is an indicator which is basically just a line that we draw on top of the chart, and that line is basically computed using X amount of periods, averaged, and plotted on top of the chart. I'll show you exactly how it's done and what it's used for. So I'll grab an Excel sheet. Let's say we want to draw a 4-period moving average. A 4-period moving average. So basically we take 4 periods. Now it could be, by 4 periods, what I mean is candles. And when we talk about candles, we talk about the closing price of that candle. So if I'm taking, let's say, the last 4, if I'm looking at a daily chart, then I'm looking at the last 4 days. So I could have day 1 here, day 2, day 3, and day 4. Let's say on day 1, the closing price on that day was $10, right? The second day was 11. The third was let's say 12, and the fourth came back or continued going up to, let's say, 12 or 14. Okay, prices kept going up. Now on the 5th day, what I'm gonna do, this is the prices here. I'll zoom in a bit here. We have the prices. Here I'm gonna have the moving average, the simple moving average, and we'll call this 4 because it's 4 periods. So what I'm gonna do here is I wanna compute what is the average of these 4 previous days. Well, the average is gonna be the first day plus the second day plus the third day plus the fourth day. This is the sum, so I have 47, divided by 4 because there's 4 of them. And this gives me the average of the last 4 days, and the average of the last 4 days is 11.75. Now, on the 5th day, maybe the price drops back to, I don't know, 9. Okay, price suddenly drops. Well, what is going to be the average on the 6th day of the last 4 days? Well, it's going to be this, right? It's going to be 11 plus 12 plus 14 plus 9. So we dropped the 10 because the 10th is 5 days before, and I want to use the last 4 days, and I add the 9. So I do the average of those, and now the average is this. And maybe the price stays at 9 the next day. Well, on the 7th day, what is going to be the average of the last 4 days? Well, it's going to be 11 because I'm using these 4 prices. So I dropped the 11, I added another 9. So it's dropping a bit. So what the simple moving average does is it takes prices and it does an average of the last X periods. And what that does is it removes the noise. So if something is really moving wildly, you don't want to see all this noise. You want to have an average of these days to have a better idea of what's going on, right? So in this case, I would see that, okay, prices are starting to drop, okay? And it's more fluid. And I'll show you on a real chart here in a second. But these moving averages, you can have a 10-day moving average, or a 10 period, or a 20 period, or a 50 period. It's really up to you. So if I grab back my chart here, and let me just remove some of these indicators that I've added in the last lecture. If I look at this chart, I can go here and I can go on indicator, and you can look for it here. You can go to moving average, which is this one. There's a bunch of different averages, and there's exponential moving averages, which I'm not going to cover here because I've always just used simple moving averages. You can get the same thing from the simple one than the exponential one. So I don't really know a lot of people who use the exponential one. the simple one just works pretty well. So you can Google the exponential one if you want, but for now, stick with the simple moving average. You can just write here MA for moving average, and you can find it. So all you have to do to add an indicator is just click on it. And here we go. We have this moving average now. You see, this line was not there before. And this line, I have a daily chart. The way it's calculated is basically like, let's say this point here, the way it was calculated is by using the last X periods to compute itself. Now, how many periods did they use? I can double click on it. They used the last 9 periods. So when you do a moving average indicator on TradingView, they default it to 9. So you can change it, okay? So how many periods you want to use, I'll tell you in a second. But here, if let's say I put 4, then you would see that, let's say here, the way they drew this is by using the close of this one, 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 just sort of like we did. Now you'll see that if you have a very short period moving average, this line here is going to follow the prices very closely, right? If I have a longer period moving average, let's say 20, you're going to see that the line is going to lag a bit. The moving average isn't going to be as fast to catch on to the price. You see? Now it's more smooth. So if you want the smoother moving average, you put it longer term. It's gonna be less impacted by the noise and by these candles. And it makes sense, right? If I'm using 4 periods and then the price jumps and I'm removing one candle and adding the new price of the other one new price entry over 4 has a lot of weight. So it impacts my moving average a lot. If I was using a 100 period moving average, I'm looking at the 100 periods. Well, if I'm dropping 1 day or 1 period and I'm adding a new one, even if this new one moved by a lot, it's only 1 out of 100 of data points. So it doesn't have a lot of impact on my moving average. So my moving average doesn't move as fast. It's very slow, right? So the longer term you're doing, the longer term moving average you want to look at, because you don't want to get caught up with all these small movements, right? Now, the moving averages that I recommend is the 20 period moving average and the 50 period moving average, and that's for Forex. Now, if you're doing stocks or something else, you want to look at the 200-day moving average, you want to look at other things, but for Forex, which is what this course is about, I really like the 20-day moving average and the 50-day moving average. So this here is the 20-day moving average, and you can see that it shows you something. Well, what does it show you? The moving average, what it shows you is the direction. So it's a trend. So instead of just looking at the prices and being like, okay, it's going down, or you can look at the moving average, and the moving average gives you the average of the last 20 periods. In this case, this is a 20 period moving average, and you can see that the direction is downward. So it's downward sloping. So it gives you an indication of the trend. Now, if you use longer period moving averages, it could also be used as support and resistance. In Forex, I don't use it as much for that. I use it in a different way, which I'll be showing you in another lecture. But you can be using the 50-day and the 20-day moving average, play around with it, and it'll give you an indication of the direction we're going. Now, you could use it as resistance points, support points. You would need to use longer period moving averages. But yeah, you can use the moving averages on either daily charts like this or any type of charts. You can use 1 hour charts. You can use, let's say if I'm going here, I can put 1 hour charts, or and you'll have the moving averages as well. You can do 15-minute charts. Whatever time frame you're looking at, it'll use the X amount of candles. So if I'm using a 1 hour chart and I'm using a 20 period moving average, I'll be looking at the last 20 times 1 hour, so last 20 hours to draw it. Okay. So this is going to be the simple moving average, and what we'll do in the next lecture is actually add on top of the moving averages to see how we can use them to find entry and exit points. In this lecture, we're going to be looking at moving average crossovers. So, moving average crossovers, what are they? The way it works is you draw 2 different moving averages on top of a chart. For example, let's say I look at this currency here. I'll go on, and it doesn't matter what time frame you're looking at. Again, the time frame depends on how long-term or short-term you want to be trading. If I'm looking at a 4 hour chart here of New Zealand dollar to US, and I add an indicator, moving average. I'll plot it here, and let's add a 20 period moving average. So I'll change this to 20, and you see, oops, yeah, 20. Okay, then I'm gonna add another one. I'm gonna add another one, and I'm gonna have the 20 period, which is the one I'm gonna call my short-term moving average, and I'm gonna add one that's longer term. Okay, that's slower to react to recent price changes. Now the second one here that I just added, I'm gonna change it from 9 to 50. So I'll have a 20 period moving average and a 50 period moving average. And look at this, the 50 period moving average is slower to react than the 20-day moving average, right? Makes sense. 50-day, more data points. Each data point has less value, so a new day, a new move impacts it less than the 20-day moving average. And what this tells me is that if I use moving average as an indicator of the direction we're going, as a trend, well, what if I have one that's shorter in term? So a 20-day one versus a 50-day one. The 20-day moving average is going to tell me about the direction in the short term versus the 50-day moving average, which is going to tell me the direction in a longer term. And what I can do is I can look at these two different moving averages and see if one changes versus the other. For example, if my 50-day moving average is going down and my 20-day moving average is going down faster, what that tells me is the last 20 days were worse than the last 50 days, because the 20-day moving average is lower than the 50-day moving average, right? But then if at one point the 20-day moving average goes above the 50-day moving average, so it crosses over the 50-day moving average, well, what that tells me is in the last 20 days, prices were better than in the last 50 days. So we might be reverting. So we've been going in a direction, but recently we're starting to go in a different direction because the shorter term period moving average crossed the longer term moving average. We'll look at it here. So let's say here, for example, okay, we're starting off and we have the short-term moving average, the 20 period, crosses below the long-term moving average, which tells me in the last 20 days, and if I look at the last 20 days, this, the prices are lower than in the last 50 days, okay? And because the last 20 days has this really big, there's these few bad prices, and these few bad prices really impact the last 20 days more than they impact the last 50 days. So that would tell me that I need to short, okay? So at this point here, I need to short, which the prices, I'll be shorting at this price, because here is what the price is. But this is the indicator, and since the shorter term moving average crossed below the longer term moving average, I want to short. I'll be shorting somewhere here, okay? Now, as long as the shorter term moving average is lower than the longer term moving average, I know that, you know, in the short term, prices are going in that direction compared to the long term. So I would stay in that position until we get to here, and I'll be closing my trade here. So I would have made some profit, okay? Now, at this point, we'll zoom in. The shorter term moving average goes above the longer term moving average, which tells me that now prices in the short term, in the last 20 days, are a bit higher than in the longer term, right? Because in this short term here, I have these days that have a bigger impact than on the last 50 days. So here I might have went long. I would have bought. This would have been a bad trade because I would have bought, but then right away, the 20-day moving average would have crossed below again because of this huge red candle, and I would have taken a loss. But that's okay. One good trade, one losing trade, which is smaller. Now we crossed the shorter term moving average, crossed below the longer term moving average again. That would have been another sell indicator, another short. I would have shorted here. Then prices went down and again recrossed over here. So I would have closed my position at this point, another winning trade. And again here, there's a whipsaw. I would have went long. I would have lost on this trade, but barely. I would have bought here and sold here, barely a loss. But here I would have shorted again because the shorter term moving average crossed below the longer term moving average. And I would have still had this trade open until today, which is pretty good because it's really deep in the money now, right? So this is how you would use it. It really tells you when there's a change in direction, okay? Because you have two different moving average, one short, one long, and the short really tells you what's going on more recently, the long, what's going on more not so recently. And when the recently moving average crosses below the not so recently moving average, it tells you that there's a shift or we might change. So you can use that to enter and exit positions. And that's where some of the indicators that you hear people talking about, like MACD, moving average convergence divergence, all of these other indicators, they're just based on that. So all you need to do is just use that, because that's what they do. They take moving averages and they see how much they diverge or they converge, and they try and do these things. Well, here you go. You can just look at it like this, and when there's the crossover, you know that there's a shift, right? And you can look at this in different places. Like let's say on this one, you can see that we crossed over. Well, we crossed over here, so you would have been in a long position and you would have stayed in this long, and you see the shorter term moving average, so the last 20 days here, right, starting to slow down, okay? And because these new days that are lower, the last 20 days are about to be less than the last 50 days. So we're about to cross below, and this would be a sell indicator. So we get out of it, we get out of our long position, so we take our profit on it, and we even go short. And you know, it's whenever you start trading and you learn about moving averages, it's the easiest way to get rolling, you know, and just to practice. Obviously, when you're practicing, you practice with fake money, so it's not a bad idea to just play around with it, because it's such a simple way to trade and to get experience in sending orders, seeing your positions, doing all of these things that you want to learn about. It's a nice way to learn about them, because it's just a simple way of doing things. And you might like trading with moving averages, and this could be your way of trading, or you could trade with something else, but it's a good way to get practice. So, you know, add some moving averages to your charts, see if you can see a crossover where you would want to enter a position or not. Anyways, we're going to be looking at entering positions and all that stuff at the end of the course, but start looking at your charts to see if you can see some crossovers. And that's really what crossovers are. You can play around with the time frames for your moving averages. You can try two shorter ones, two longer term ones. You can try different time frames on your charts, play around with it. And yeah, that's it for moving average crossovers. The indicator we're going to look at in this lecture is called Bollinger Bands. So Bollinger Bands is one of my favorite indicators to use. I use it in stocks, Forex, and cryptocurrencies, and it makes a lot of sense to use. And it's very intuitive, and you know, you wouldn't, even if it didn't exist, I would have used it by looking at the chart, but it just makes it so much simpler. It really highlights what I want to look at. So what is Bollinger Bands? You can go on indicators here, you can write Bollinger Bands, or you can just write BB. It knows it's Bollinger Bands, and it's the basic Bollinger Bands that we're going to be using. And what Bollinger Bands is, okay, is basically, and I'll go here on this chart, is basically a moving average that's drawn in the middle, and here you can double click on it. It's a moving average that's based on the last 20 periods, okay? So it's a 20 period moving average, and there's a upper band that's drawn above this moving average and a lower band that's drawn below it. Now, how is it drawn and how is it used? Very simple. Now, the way it's drawn is basically they're using what we call a bell curve. So in mathematics, you have what we call a bell curve. And a bell curve here is used to measure distributions around a variable. And this could be anything. It could be, I don't know, grades in your class. It could be height of men. It could be prices of houses. It could be whatever, okay? You can use the normal distribution to draw these entry points. So example, I could say that the average height of a man is 1.7 meters, okay? And then I could try and see, well, what is the probability that a man is 1.5 meters or 1.4 meters what is the probability that a man, or how much of the population is above 2 meters, right? And it would be like this part here. Now, what we want to do is use the bell curve, or use this normal distribution, but for prices. Okay? The way the bell curve is drawn is it uses what we call a standard deviation. And the way we use it is we take all these data points and we say, okay, well, what if we want 66% of the population, okay, to be within 1 standard deviation of the mean? Well, then what is a standard deviation? So example, if I say I want to know between which range are going to be 66% of the population between this height, and then I'll figure out what a standard deviation is, and maybe I'll find that, you know, 1 standard deviation is going to be equal to 10 centimeters. So then I know that there's 66% of the population between 1.8 meters and 1.6 meters, right? Because I know that in a normal distribution, there should be about 66% of the variables within 1 standard deviation. And you can actually just Google it. I'll Google it real quick. Bell curve standard deviation. So there should be between 2 standard deviations, 96% of the population, and then between 3 standard deviations, 99% of the population. So let me find a good one here. Okay, so between 1 standard deviation, you have 98%, 2 standard deviation, you have 95%, and 3 standard deviation, you're gonna have 99% of the population. Okay, here you have it here, right? 68, 95, and 99. So what we're doing, without getting into the math and calculating standard deviation, because you can go look at it, but I want to keep this as concise as possible. We're, instead of using it on men heights or anything like that, we're using prices. So we're looking at the last 20 periods, we're looking at the prices, and based on the volatility, the more something is volatile, so let's say if men heights were very volatile, some men were really tall, some were very small, then 1 standard deviation would be maybe 20 centimeters, right? So to have 66% of the population within that range, it would have taken a bigger range, right? So the more volatile something is, the bigger the standard deviation is. So what we want to do is look at prices. We're looking at the last 20 periods of prices, we're looking at how volatile they are, and we're deciding on what a standard, the math decides on what a standard deviation is. And then what we do is we draw a bell curve around the price. So imagine this, imagine I have my chart here, and I have prices who fluctuate. What I'm doing is, based on these prices, I'm drawing a bell curve. And I'm saying, you know what? This is the prices and this is how they act, the price acts. What is the probability that the price stays within 2 standard deviations? Well, I know that there's 95% chance that it stays within 2 standard deviations. Okay? So now I can say, well, I'm very confident that the price is going to be within there. So I'm going to draw a lower band at this 2 standard deviation here, and a higher band at 2 standard deviations above. And then I can be confident that the price of this currency is going to stay within those standard deviations, because it's very unlikely that it goes outside of it. It's only 5% chance that it goes outside of it. Or I could say I want to draw bands at 3 standard deviations. So it's 99% chance that the price stays within those bands, right? So this is what's done here. When you're drawing this, we are drawing a moving average with a lower band at 2 standard deviations below the moving average and 2 standard deviations above. So we have a 95% confidence that the price will stay within those bands. And if I double click here, you see that it's using a standard deviation of 2. Now, if I want to be more confident and I want to widen my bands and I want to take the extremes out of this bell curve, I want to be 99.7% sure that prices will remain within this range, I can increase it and put a 3 standard deviation. And you'll see that my bands are going to widen, right? And now my bands are bigger, okay? The way you would use the bands is be like, okay, well, you know what? If prices drop, it's very unlikely that it keeps dropping because, it's already so far out. So I'm going to buy when it touches the lower band. And then when it comes back, I'm going to get out here. I'm going to take my money. And here I'm going to buy again because it touched the lower band. And here when it touches the middle band, I'm going to get out. And here again, it barely touched them. So here I would have shorted and here I would have gotten out. So these are all profitable trades. But you could have used a 2 standard deviation and gotten way many trades. But again, you would have gotten them early, but you would have gotten a lot more trades here. So, if you're more aggressive and you want to get more trades, you use tighter bands. If you want to take very fewer trades, you use wider bands and get those trades that are at extremities. Now, when do you use a Bollinger Band as an indicator? You're just not going to use it all the time. A Bollinger Band really looks at deviations from the mean. So you want to use it in a mean reverting strategy. That means when you're trading something that you believe is going to mean revert, meaning that when it goes up, it's more likely to come back down, and when it goes down, it's more likely to come back up. Not in something that's trending or that can go in a momentum in a direction. You don't want that. So I would like to use something like Bollinger Bands between currencies that are very similar. Example, Canadian and Australian dollar, which have very similar economies that move in similar fashions. So when they deviate from each other, they reconverge, and when they converge too much, they redeviate. So to trade this currency pair using an indicator like Bollinger Bands makes a lot of sense, because when they deviate from each other, they reconverge back. When they converge too much, they redeviate back. So you can use this to see how far have they deviated from each other, and at that point, get into a trade. And you'll see in something like this, even I'm looking at this currency here, you can see that here you would have gotten a lot of good trades. You would have been able to buy the lower bands, get out in the middle, short at the higher bands, get out in the middle, buy the lower bands, get out in the middle. Here, short, get out, buy, get out, short, get out, buy, get out, short, get out. Here you would have shorted, and when you would have gotten out, you would have lost money. So here's a losing trade, but all of these were winning trades. And here, all of these are winning trades. So one losing trade and all of the others were winning. So very good indicator for this currency at this particular time. Now, one thing you want to watch out for is that in the financial industry, the bell curve is not a regular bell curve. So usually the bell curve, regardless of the industry, looks very similar. But in the financial industry, what we have is what we actually call a fat tail curve. So instead of having a regular bell curve like this, what we have is a fat-tailed curve where it looks more like this. Well, sorry for my drawing. Wow, this is so bad. Let me just redraw this. Might be even worse. Okay, so basically, things that usually happen here in the middle, they're more likely to happen, and things that are very unlikely usually, things that usually in a regular bell curve are very unlikely, are more likely in the financial industry. So this is why we don't really call them bell curves in the financial industry. We call them fat-tailed bell curves, because things that are very unlikely tend to happen way, way, way more often in the financial industry and trading. Things that you would think would never happen, they seem to happen all the time. So just understand that it's not because you're at 3 standard deviations or 4 standard deviations that the price will never go there. Prices will go there often. So you just want to be careful in your position sizing and all of that, because prices can go to those extremes very often. So this is what Bollinger Bands are. So what I would challenge you to do is look at your charts again, see if you can find a currency where Bollinger Bands look to work pretty well on, and see if there's a reason for that. See if those currencies are actually or have similar economies, and you would want to use this indicator to trade them or not. In this lecture, what we're going to look at is the RSI, short for Relative Strength Index. Now, what the Relative Strength Index is is basically an indicator that's drawn at the bottom of your chart. You'll see it at the bottom of your chart that tells you something about if this product that you're trading is overbought or oversold. Now, the way that it's calculated is it takes a look at the last 14 candles. Okay? It takes the last 14 candles and it takes a look at the size of the green candles versus the size of the red candles. Now, if the green candles are way bigger than the red candles, so if the green candles are bigger than the red candles, then the RSI is going to give you a big value. So the RSI, the values that it can range between are between 0 and 100. So if the green candles are way bigger than the red candles, it'll be closer to 100. Now, if the red candles are way bigger than the green candles, then the RSI's value will be closer to 0. Okay? Usually, around the RSI line that you see here, we are going to draw a line at the bottom and a line at the top. Now, you can decide at which location you want to draw these lines, but usually they are drawn at the 30 level and at the 70 level. And that's the default, and that's what everybody uses. Some people are more aggressive, they use 20 and 80, but usually it's 30 and 70. So what we say is, if the value is below 30, we say that the product that you're trading is oversold. Why? Because the red candles are way bigger than the green candles. So it's oversold. Now, do you want to buy something that's oversold? Well, what do you think? If the RSI's value is above 70, we say it's overbought. Why? Because the green candles are way bigger than the red candles. Okay, so it's overbought. People are buying it more and more aggressively, right? That's why the green candles are way bigger, because the buyers are buying it so more aggressively. We say it's overbought. Do you want to short something that's overbought? Now, the reason why you don't just want to short something that's overbought or buy something that's oversold is things can remain overbought or oversold for a very long time. Imagine this. Imagine there's something that's dropping. Red candles are way bigger than green candles. So it's oversold. And you see it's oversold, then you're like, you know what? I want to buy it because it's oversold. It's going to come back up because sellers are selling it more and more aggressively. Red candles are way bigger. And you buy it. And then guess what happens the next few days? Red candles keeps getting bigger and bigger than the previous red candles. And the green candles keep getting even smaller. So then it's even more oversold. So things can remain oversold for a very long time. If you're looking at stocks, some stocks go down to 0. So people can, and even when you're looking at currencies can fluctuate a lot. So things can remain oversold or overbought for a long, long time. So you don't want to just buy something that's oversold, and you don't want to short something that's overbought. What you want to do is wait for it to stop being oversold or overbought and then get into a position. For example, if you look here, prices, red candles are getting bigger compared to the green candles. And you see here it becomes oversold. Now, I don't want to buy as soon as it became oversold. I want to wait until it stops being oversold and the RSI line crosses over above the oversold line, because you see here green candles started being bigger than the red candles and it's not oversold anymore. So then I would buy the position, and then as it goes up, here it became overbought. I don't want to short right away, but when it stops being overbought, again because of this red candle that's way bigger than the green candles, then I want to get into my short position. And again here, it would have been a profitable trade. Again, oversold, I don't buy right away. I wait until it stops being oversold and then I buy. Right? So if I'm looking at a currency here and I want to look at the RSI, all I have to do is go in indicators, type RSI, the first one it shows up, Relative Strength Index, click on it, and you see the RSI at the bottom here. Okay? So let's say if I'm looking at the price here right now, well, imagine this. Imagine I want to buy this currency, or imagine I want to short it, sorry. Imagine I want to short it. Well, would I short it right away? Not necessarily, right? Because it's trending up. And then look at this. Here it becomes overbought, because the green candles are way bigger now, you can see them, so it's overbought. Well, am I going to short right away? No, not necessarily right away. I want to wait until it stops being overbought. Okay? So there's the potential for reversal. Okay? And this is what this indicator is going to help me with. And I see here that red candles became bigger all of a sudden, and green candles became a bit smaller. So then it stopped being overbought. So this would tell me that, you know what, at this point here, that it stopped being overbought is a good place to short. Okay? And then, guess what? Well, that was a good place to short. So it helped me in not shorting too early, right? And this could have been done the other way around. Prices could have been dropping, and if I wanted to buy this product, well, or let's say here, right? Let's say while it was dropping, I wanted to buy. Well, when do I buy? And there's this big red candle. Do I just buy here? No, because this could have continued dropping, right? But then when I see that, okay, the green candles came back bigger and the red candles became smaller again, we're not sold anymore. We were, but we're not. Then there's a potential for reversal. Then I would get in here. And again, that would have been a really good trade. So you can use it in both sides. It's used for reversals, and you want to always not buy as it's overbought or oversold, but when it becomes that and then stops being that, that's when you enter a position. So my challenge to you is look at your charts, put the RSI indicator on, see if you can find some places where there is a reversal that happens and you could have spotted it through the RSI. Again, with all these indicators, the more you use them, the more you play with them, the better you'll get at spotting when to use them and when not to use them and how to use them, and you'll get better at using them as well. So that being said, that's the RSI. I'll see you guys in the next lecture. In this lecture, we're going to be talking about the Fibonacci retracement indicator. So this indicator is based off the Fibonacci sequence, or the Fibonacci ratios, developed by Leonardo Fibonacci, who's an Italian mathematician. And all of this is going to be based off the Fibonacci sequence. And the sequence is basically a series of numbers, and each number in the series is the addition of the previous two numbers. For example, we have 0, 1, and then the next number is going to be 0 plus 1, which gives you 1. The next one is going to be the addition of the previous two numbers, so 1 plus 1, which gives you the 2. Then here we have 2 plus 1 gives you 3. 3 plus 2 gives you 5. 5 plus 3 gives you 8. 8 plus 5 gives you 13. So each number that you have is just the addition of the previous two numbers. And this keeps going on forever, right? So I can just open a Google tab here, and we can just write Fibonacci sequence. And you'll see here that the sequence keeps going, right? Now, one really nice thing that we get out of the sequence is some ratios. And the ratios that you can get are basically when you divide one of the numbers by the next number. Okay, so I'll pull up a calculator here, and I'll go 610 divided by 987. It gives me 0.618. Okay, if I take any other numbers, like let's say 6, I'll take this one here, 6765 divided by the next one, 10946, I'll get again 0.618. So whichever two numbers I divide like that will give me the same ratio. And you can look into the Fibonacci sequence. There's a bunch, and this is one of the reasons why it's used in trading, because it's something that you can see throughout nature and throughout architecture, throughout beauty. You can see it in the face of people that we find beautiful, ratios between different aspects of their faces. You can find it in nature, you can find it in the pyramids, you can find it everywhere. And this is why it's very well known. You've probably heard of it before. Either you've heard of Fibonacci sequence, or you've heard of the golden ratio, which is based off of that, or phi, or any of these things that relate to the Fibonacci sequence. So you can actually watch documentaries about that. Anyways, now how do we use these ratios in trading? So there is an indicator that we can use here, and I'll pull a chart here, that's called the Fibonacci retracement levels. So when you open TradingView, you can go here, and then you have a bunch of different indicators that you can use. One of them is called Fibonacci retracement. And you'll see that there's a lot of other indicators based on the Fibonacci here. Fibonacci channels, wedge, and you can look into those, but the one I prefer is the Fibonacci retracement. And the way it works is once you select it, you have to select a true and a peak. So you select here the lowest point that you see and the highest point. Now once you select the highest point, you can just extend this further so you can include the rest of the chart that you want to see. And basically what's going to be drawn here is some of these Fibonacci ratios. So you see here we went from 1 to 0 or 0 to 1, it doesn't really matter. And you have levels at the 23.23, so the 23% from this level here, 38% from this level, 50%, 61.8, and 78.9. So you remember here the ratio we just calculated? 61.8, that's the level here, right? Now, how do we get these other levels? Well, take a look at this. If I take, let's say, 610, instead of dividing by the next one, I'm going to divide by the next one after that. So divided by 1597, what am I going to get? 38.1. And this is the level here, 38, right? And if I go another one further, so let's say I go 610 divided by not this one, but this one, 2584, and I could have chosen any numbers and divided it by the 2 after that, it'll give me the same thing. I'll get the 23.6 level here. Now, one of these levels here on the Fibonacci retracement isn't actually a Fibonacci level, and this is the 50 one, the midpoint one. This is just added because a lot of times you'll see that retracement does happen to this level, so it's been added there. But it's not an actual Fibonacci ratio. And you can actually play around with this. There's some really nice mathematical properties. Let's say if you go 610 divided by 1597, and we get back the 0.381, which again is this one here, right? Well, look at this. If I do the square root of this number, guess what I'm going to get? So square root, I'm going to get 618. So I'll get this one here. Now if I do the square root of that one, 78.6, which is this one here. Right? So there's some very nice mathematical properties with this sequence here. And the way it's used basically for this indicator is once you draw the true to the peak, you're looking at something that's going in one direction and you believe it's going to keep going in that direction. But it's a natural and healthy thing for things to pull back or retrace before continuing in that direction, right? Now the thing is, how far are they going to retrace? And what we found is, or what has been found, because I didn't do the research, just what has been found, is that retracement tends to happen to levels that are computed through the Fibonacci sequence. So it's more probable for retracements to happen to some of these levels here, like the 0.38 or the 61% level or the 78% level. So because of that, when you draw this indicator, you get all these levels there. So you know that there is a high probability that we pull back to one or several of these levels. So if you're planning on, or if you think that this position or this currency is going to continue in that direction, but you don't just want to buy right away, you want to wait for a retracement, you can place your orders at those key levels because you expect it to bounce back off of one of these levels and then continue. So one of the ways you would be trading something like that, if you want to go long, in this case USD CAD, and you just don't want to buy at any level and you expect the trend to continue, well, you can place your order at, and you can split your orders. One of the ways I like to trade is split my orders in 3, put quarter of it somewhere, another quarter somewhere else, and then half of it somewhere else. So I do pyramid position sizing, which we'll look at later when we talk about position sizing and how much to buy and where to buy. But basically, you can place part of your order here. So you can buy 25% of your position here. And then if the position keeps going against you, you know that at the 50% level, there's high likelihood that it goes back up. So you put another quarter of it here. Once it goes back up, you can sell that quarter that you bought here at a profit while keeping the previous quarter that you bought here longer. It falls back, you can buy again that quarter here. It falls to this level, the 61 level, then you can buy the remaining half here. And as it goes up, you can sell that half here. Goes up, you can sell the position you bought here over here. Goes back down, you can buy again. So you're trading this range here, right? Comes back down, you can rebuy the position that you had bought here previously. Goes back up, you sell it, goes back up. The position that you bought here, you might have sold here, unless you wanted to keep it for longer. So you can really trade those ranges and have, you know, specific entries in the same way we use all technical analysis, just for finding entry zones and exit zones and being able to get in, get out, get in, get out, and you know, go back on another currency and do trades with your funds while not using them in this position, instead of just buying and holding it and, you know, just holding long term and going through all these movements without capitalizing on those movements. So this is the Fibonacci retracement indicator. It's based off the Fibonacci ratios, based off the Fibonacci sequence, and you know, you can use it when you're looking at something that's going in a specific direction, you're expecting a retracement, and you want to find optimal entry zones based on the Fibonacci ratios to get in and get out of your position.